What is the S&P 500? The S&P 500 is a stock market index. It's basically a scoreboard for the stock market. Instead of looking at just one company, it tracks the performance of 500 of the largest US companies, like Apple, Amazon, Microsoft, and Coca-Cola. What's interesting is that together, these 500 companies represent about 80% of the entire US stock market's value. That's massive, right? Well, that's why the S&P 500 is often seen as a measure of the US economy's health, because it reflects such a large share of American business. If you're finding this helpful, make sure to subscribe so you don't miss more investing breakdowns like this. An easy way to think of it is like a class average. Instead of grading one student, you look at how all 500 students perform. And if most students do well, the average rises. If most do poorly, the average drops. Now that's how the S&P 500 works. It shows the market's overall grade. Here's the catch. The S&P 500 is market cap weighted. That means bigger companies move the index more. Apple, Microsoft, Amazon, and Alphabet together make up over 20% of the index. So here's the effect. If Apple stock rises or falls, it shifts the scoreboard far more than a smaller company. But a fact is this isn't an open club. Getting into the S&P 500 is like entering the VIP section of the stock market. A company must be US-based, worth at least $14.5 billion, highly liquid, and profitable. If a company slips and no longer meets the requirements, it's kicked out and replaced. The smart part is the index is reviewed every quarter, so it's always packed with the strongest players. Why does this matter? Because liquidity keeps the index stable and trustworthy, so investors can trade in and out on the market without big price swings. Here's something most people miss. The S&P 500 is diversified across 11 sectors like technology, healthcare, finance, and energy. Tech currently dominates, but you're still getting a broad slice of the economy. Another great advantage is on top of stock growth. The index also pays dividends, averaging about 1.5 to 2% annually. Now, let's talk about the money you can make. Historically, the S&P 500 has returned around 10% per year on average. But here's the reality, it's not every year. Sometimes it's up 20%. Sometimes it drops 30%. But over decades, a return per year on your investment evens out near 10%. And here's the surprising truth. Most professional investors can't even beat the S&P 500. Even S&P's own SPIVA report shows about 85 to 90% of large-cap funds earn lower returns than the index over 15 to 20 years. A large-cap fund is simply a fund that invests in the biggest U.S. companies, the giants worth billions of dollars. These funds are run by professional managers whose job is to research stocks, buy and sell them, and try to beat the market on behalf of everyday investors. And here's the kicker. They're often investing in the same types of companies already inside the S&P 500. So you'd think they could at least keep up, right? But most don't.
Why?
Because after management fees, trading costs, and stock picking mistakes, they usually end up trailing behind the index. So, what does all this mean for you? If you're enjoying this, subscribe. It helps the channel a lot. If you invested $100 a month for 10 years, you'd put in $12,000. And with average returns, it could grow to about $20,000 based on historical averages, not guaranteed. It could end up lower or even higher. Surprisingly, if you put in a $100,000 lump sum at once, and the market delivered its historical 10% annual average, in 10 years you'd have about $259,000. That's called the power of compounding, when your money earns returns, and then those returns earn even more returns over time. And here's the reality check. Investing $100 a month into the S&P 500 for 10 years won't make you rich. A big advantage is that it builds a solid cushion for emergencies or future goals. The truth is, real large wealth often comes from larger investments or a successful business. But I have to say, the S&P 500 is still one of the most reliable tools for long-term wealth. But a huge issue is that if your money just sits in the bank, inflation slowly eats it away. Inflation means prices of everyday things rise, on average about 2% a year, which makes your cash lose buying power over time. So, what happens if you don't invest? You're actually getting poorer without even noticing. Luckily, investing in the S&P 500 has historically helped money grow faster than inflation. So to put it, the S&P 500 shows investors how the US stock market is doing and whether their own investments are keeping up. One of the most resilient wealth-building tools is the S&P 500, but only with steady, long-term investing of a decent amount of money. So if the stock market is a scoreboard, the S&P 500 is the team you can bet on for steady wins over the long game.